I had a really interesting conversation today about TGI Fridays with a friend, and this is a brand that I view as quintessentially American. It's one of those brands that's been around a long time and really shouldn't be in the position that it's in. Um, but as a concept, it helps illuminate a couple things that I think are important to chat about from an employer brand standpoint, and it also shows how linked employer brand is to the operational efficacy of a company, and then also sales and revenue. And I'll caveat, this whole talk by saying this isn't an issue that's exclusive to TGI Fridays. In fact, with the way that the labor markets are looking right now, I mean, just to recap, there's something like 10.5 million open positions right now, and the labor shortage is really growing. Companies are having a difficult time figuring out how to close the gap, whether it's through pay or benefits or some other reason. That this is going to be something that I think we're going to see more brands face going forward. And it's just interesting to think about. And so I'll set it up this way. So my friend, my mentor was driving past the TGI Fridays today, and he mentioned that it looked like it was going out of business. It looked very run down, and it looked like it might have been closed. But he ended up kind of driving closer. It was open, and then he noticed that there were a lot of for hire signs outside. So here you've got a kind of a brand that needs a little bit of revamping, or a location that needs a bit of revamping. Looks like it could be closing, but it's still hiring. And so that raises a couple issues, right? So as an employee or as a job seeker, what would motivate you to join a company that you feel like, oh, they could be going out of business in a couple months or in a couple years? And so that's the fundamental problem number one. When I think of TGI Fridays, I think of the logo, of course, with the kind of candy red and white stripes. I really do think of a brand that is quintessentially American. I mean, the way that the dining rooms are set up. I remember growing up outside of America, and there were a few different brands that I thought, oh, you know what, like when I get there, I'm gonna definitely go have a look. And you have the Coca-Colas, you have those kind of things, the stadiums, the baseball stadiums. But TGI Fridays was definitely one of those brands that I thought, okay, if I get the chance, I'm definitely going to go. Here's a company that was founded in 1965 and has a global presence. So they've definitely seen success, and they know what they're doing from a balance sheet standpoint. They, as of February of 2020, they're sitting on 869 store locations. But the coronavirus really kind of threw a wrench in their operations. So when I was doing a bit of quick research before this chat, it looked like they were having to close 386 store locations globally. And here, what we're going to see is that we're going to start to see this spiral that's difficult for a brand to get out of. And it's hard also to pinpoint exactly where the start of the problem is. So since the start of the pandemic, we've seen brands struggle with labor, right? So a lot of the times brands will point to the job market and say, look, we can't find the talent that we need, therefore we can't service our customers. That's why sales are running low. So you've got that kind of first step. And then the second step is, because we don't have sales, we don't have revenue, we then can't invest in things that are going to be sustainable advantages for us going forward. So things like menu innovation for a brand like TGI Fridays, or store decor, or things like that keep a business viable, and it keeps things attractive for both the customer and an employee. And when you can't invest in kind of the appearance of the brand, you run right back into that problem with employees. We go back to that first point I made, which is, how do you compete as a brand that's struggling with other companies that employees know is gonna be around for a little while? So how can, at whatever price you want to set, 15, 16, 17, 18, 19, $20 an hour, how do you compete as TGI Fridays with a location that's falling apart, as my friend was saying, with an Amazon that is got one of the strongest balance sheets probably out there? Another downturn happens, that you're still going to have your job at Amazon if things go south. Whereas if you go and get a job at TGI Fridays, how can you be certain that it's still going to be there? We've got to remember as employer brand practitioners that the job market is finicky, and workers, we like to think of tenure, we like to think of things that of loyalty and things that the workers have, but workers are primarily concerned with their resume, right? And their own upward trajectory with their careers. And so we've got to think that as a brand like TGI Fridays or any other brand that's facing this downward spiral, how can it compete at a resume level for employees, right? Does somebody who's 18, 19, 20, 21 years old want to put TGI Fridays on their resume and then have to explain in a couple of years why they're no longer there? I think that the same thing will have happened kind of with Blockbuster back in the day. And you have these brands that are kind of legacy plays. They're strong. They should be stronger than they are, but couldn't see kind of around the bend. And I don't want to use the term complacent, but that's what it kind of ends up looking like it is when you have strong brands that can't keep up with the pace of the market. And granted, consumer tastes change and things, but there's no reason why when TGI Fridays was at its heyday and building out these, some 900 stores globally, that it couldn't have been strengthening its position such that it could weather a downturn like this or protect its brand from a downturn, and keep this spiral from happening. So again, the spiral looks like we can't get the talent that we need to service our customers. Customers then don't want to come. We lose sales. We lose revenue. We can't reinvest back into the parts of the business that we need to make it sustainable. And then we can't then, because the brand doesn't look strong from a resume standpoint, kind of going back to that point, we can't then find the people to work for us. So you see how that kind of circle starts to happen. And so it's just an interesting point or an interesting phenomenon that happens from a strategy perspective. It's always difficult. I think the fundamental reason why it happens is different from brand to brand, and company to company. But it shows you how important it is to maintain or invest in the things that keep what I'll say is kind of one of the most important parts of that equation, which is the people, sustainable long term, right? You've got to be investing in that employer brand to make sure that you have the talent. You've always got a pipeline of great talent coming into your business, and your brand has to be attractive to people to come to your business such that you can then protect your revenue, protect your sales. So what are the key takeaways from this topic? Brands have to be aware that this phenomenon exists. And in my opinion, the only way to protect from it happening is to make sure that when you have the balance sheet power, when you have the free cash, to invest in the things that make your brand attractive to the employees at an employer brand level. Because only then can you protect yourself from any labor market kind of implications of a downturn. And if you put employees at the top of the equation and at the bottom of the equation, making sure that those two areas of the triangle or the circle are strong, looks like it might be the way to go in terms of protecting your brand for the long term.